the bigger sort of economic picture, the recovery, such as it is from the pandemic, I mean, usually we look at GDP, the economy, in growth terms, the yearly, quarterly change in output. But I think it's more informative because the economy has been so unprecedentedly volatile through the pandemic, the recovery, Russian war in Ukraine, etc. I think it's more informative to look at where the economy is in terms of the level of output. As I say, individual yearly growth rates can be a bit misleading. And I think this gives you a more accurate sense of what the economy has done over the last few years, namely not a great deal. Essentially, growth has stagnated for about, the economy has stagnated for about a year and a half. And I think we've probably got another 18 months or so of the same. It's not a disaster. I mean, historically, the growth rates we're looking at the moment, maybe 0.5% this year, stagnation, mild contraction next year. This is pretty weak. I mean, pre-global financial crisis, the UK would be growing at about 1.5% to 2% a year. Trend has probably come down. It's maybe closer to 1. So it's sluggish, but nevertheless, the labour market is still quite buoyant. And I mean, ultimately, I think this cost of living crisis, to a large degree, it really does depend where you are in the income distribution. So frankly, for most of the people in this room, it's manageable. For a lot of the wider economy, these are pretty tight times. In broad terms, why do we think this stagnation persists? Well, firstly, although the Bank of England has been raising interest rates since the end of 2021, the bulk of this hasn't really hit, certainly households, not through the mortgage market channel. Mortgage debt accounts for the bulk of household debt. That's still the most powerful channel through which Bank of England interest rates influence consumer demand, consumer spending. So the full force of this is yet to be felt. And I think we're pretty close to the peak in interest rates in the UK, probably at them in terms of policy rates. But from a mortgage market perspective, as people refinance over the next few years, there will be an overall further monetary tightening. So more expensive borrowing has still to have its full impact, and that will tend to slow overall consumer spending. On the corporate side of the world, business investment has been particularly weak in the UK for a number of years now. Understandably, with risks of recession or broadly stagnant economic growth, higher funding costs, there's generally a defensiveness in the corporate sector. Not outright pessimism, and there'll be variations by firm and by sector, but there's a hesitancy, and I don't see at the moment business investment leading any recovery, at least not over the next 12 months. The government's sort of contribution, fiscal policy, is still quite supportive. We're running still sizable deficits, but those fiscal taps, they're not going to be turned off a year ahead of an election, but certainly beyond this time next year, there's a sort of medium-term fiscal restraint coming. And again, I think that's going to hold back the economy a little bit. What about recession risks? I think they are rising. At the moment, our central case is only a very mild, relatively short-lived recession. One of the most closely watched high-frequency economic indicators is this thing called the PMI, a survey of purchasing managers. And essentially the way this survey works is there's really nothing very complicated about it. A 50 reading is the sort of expansion-contraction threshold. The further above you go the faster the growth that's being signaled. The further below, the faster the rate of contraction. The shaded areas are historic recessions. These data go back to the late 1990s. So the right-hand side of the chart, the latest PMI surveys are fairly subdued. We're below that. We're into contractionary territory. Perhaps the good news is that the PMI has predicted 7 of the last 2 recessions. So just because we're here, you did hear that right, 7 of the last 2 recessions. It can be quite volatile. I mean, if we strip out the sort of pandemic lockdowns, which were clearly not conventional economic recessions, there have been 7 occasions where we've been, 45, 46 type territory on this survey, and recession has not materialized. What I would say is from here, obviously the longer we remain at these levels, the bigger the risk of recession. But nevertheless, I think the survey is telling us that whilst the general business climate is a little bit subdued. Risk of a mild, short-lived recession. It doesn't feel overly serious at this point. Quite a bit of variation across the economy by sector. I mean, there are, you can slice and dice the GDP data in a number of ways. These are the sort of, dozen or so key industrial sectors in the UK. And quite a bit of variation. I mean, something at the bottom like mining and quarrying, this includes North Sea oil and gas, so naturally extremely volatile output. You could really discount that to a degree. Things like electricity and gas down at the bottom, I mean, this is really, I think, a structural response to the Russian invasion of Ukraine. Businesses, households are using less energy. They're obviously got a lot more expensive, but we're finding ways of cutting back on that, which fundamentally is a good thing, even though it's a negative for the GDP data. Again, sort of working our way up from the bottom, transportation and storage-wise, that's so weak. We've had a lot of strike activity, particularly in areas like the rail sector, bus transportation, weighing on output there. And what you can see, therefore, sort of above that, for two-thirds, three-quarters of the economy, it's not doing a lot. Kind of either mild contraction, mild expansion. I think sectors, for example, like real estate, you're seeing the impact of higher interest rates really slowing economic activity. Wholesale and retail, about two-thirds of the way up, that's beginning to feel a little bit of a pinch. Consumer spending is, disposable incomes coming under a little bit more pressure. And some of the sectors up at the top there, particularly things like information and communication, ICT is, always reporting strong growth. It's by definition, it's, a sort of high value added sector. So again, depending maybe, where your business is focused, that might give you a sort of benchmark. As I say, for most of the economy, it has a pretty sluggish feel. There doesn't seem to be anything particularly dramatic going on. Some good news, eventually. Inflation, which has been the big economic shock over the last year or so, is now falling quite decisively. We'll get some more data next week. We should get another sizable fall, and then the data for the current month in October, you've got this next sort of off-gem domestic energy cap. We're going to get another big leg lower in inflation then. So the black lines are our forecast. We don't think we get all the way back to the 2% target until maybe around the middle of 2025, so still some way off, but the direction of travel is pretty clear, and there are some easy yards, certainly the remainder of this year, just as those energy shocks are unwinding. And really that's what the chart shows. The sort of red and orange bars in this chart are essentially sort of imported inflation or import-heavy inflation components. So energy, so the auto fuel, petrol, food, and that sort of the sort of post-pandemic supply chain cost shock, and then the Russian invasion of Ukraine, obviously a huge shock for natural gas prices. That's now largely washed out. The energy shock is largely behind us. Food price inflation is starting to fall quite quickly. The tricky or the problematic bit are really the blue bars. It's that services inflation is still quite high and a little bit sticky. And this is the bit that policymakers are wrestling with. Inevitably, a lot of services firms, of course, are hit by higher energy costs and so on. So some of this will just simply be a reflection of the energy costs and higher costs generally that businesses are facing. But we've also got evidence of second round effects, knock-on effects, that pricing behavior is still a little bit elevated, and that needs to moderate a bit further. But from an 11% peak in inflation last autumn, as I say, by the end of this year even, we should be down to sort of 3% type territory. It's a big improvement. Obviously, that getting inflation down has required really quite sizable rises in bank rate from historically low levels. And although historically a sort of 5.25% interest rate is not particularly high, that is the biggest rise in interest rates really since the late 80s, early 90s. So the degree of the change in monetary conditions is really quite significant. And I know this can sometimes sound a bit abstract. Well, do we really care that much about bank rate? I mean, this has a huge impact on households' spending capacities, their discretionary income, businesses' ability to service debt, to borrow, to invest. These rate rises have been designed explicitly to control inflation, but to control inflation by lowering demand, by reducing expenditure. As the chart shows, I think we're at the peak in rates now. There's a small risk that the Bank of England could nudge rates up again, a quarter point rise to 5.5% at the next meeting at the beginning of November. But I think on balance, they won't. And then they have this sort of metaphor that they're saying, they're talking about sort of table mountain profile for interest rates. And obviously relying on a sort of very well-travelled middle-class audience to fully sort of appreciate the intricacies of this. But in essence, the argument is that, Table Mountain's not particularly high, we don't have much further to go, but it's pretty flat, and don't expect early interest rate cuts. And I think that's probably right, though the purple line, our forecast, we think we probably do see rate cuts before the end of next year, probably not in the first half of 2024. But for me, policy settings are already at restrictive levels. They are restraining the economy. As inflation is more clearly heading back towards its 2% target, I think they can start to lower interest rates to move those rates down to more neutral levels. Now, I don't think that means back to 1 or 2% rates, but 4% I think would be a rate that would seem consistent with hitting their inflation target over the medium term, and one that isn't going to choke the life out of the economy either. Maybe you could make the case that rates might have to go a little bit lower if we end up in a more protracted, deeper period of economic slowdown, but I would say that's a sort of a reasonable assumption. The red line is just what financial markets are pricing today, so in other words, not quite as dovish a profile for rates as what we're looking for, maybe some risk of one further rise. I think if we get through the November meeting without another rise in rates from the Bank of England, you'll see those market rate expectations start to come down a bit more dramatically, and that will begin to feed through to real-world borrowing costs, mortgage products, borrowing rates for businesses. And just on this point, I sort of alluded to it at the beginning, just to sort of emphasize that my job has never been more difficult. I mean, obviously, I tell this to my bosses every day, but it really isn't. Monetary policy forecasting, back in 20 years ago, everybody pretty much was on a variable rate mortgage. So when the Bank of England put up interest rates, within a few days, certainly within a month, pretty much everybody with a mortgage, their debt servicing costs went up. So pretty much immediately. Now, almost 90% of the UK mortgage stock is tied to fixed rate products. And within that overall stock, about half of it is now linked to 5-year products. So we've moved from variable rate to fixed rate, but we've also lengthened the maturities, if you like, the periods of those fixed rates, which at historically low interest rates made perfect sense. What it means from a monetary policy perspective is that as the Bank of England raises interest rates, the blue bars on this chart, just the cumulative increase since they began tightening at the end of 2021. Although the sort of mortgage rates, the shop window mortgage rates, you go online to see what deals are available, which is kind of the pink line here, have risen broadly in tandem. Because so many people still have the protection of a fixed rate product, the actual impact overall on debt servicing costs is still pretty small, and that's the dark red bars on this chart. In other words, only about 1/5 of the Bank of England policy rate rises that they've delivered over the last 18 months or so have actually reached debt servicing costs. In other words, a lot more tightening is still to come through, and so even if the BOE stops raising rates now, as we think, certainly through all of next year, it will feel as if they are still raising rates, because people will be coming off those 2-year, 3-year, 5-year fixed rate mortgages and essentially going from a 1.5%, 2% borrowing rate up to 5 or 6. And that's why we think consumer demand will remain under a bit of pressure this year. The other big issue, both around controlling inflation, but also in terms of the broader economic outlook, is the labour market and what's happening to employment. Now, if you told me 2 years ago that the economy was essentially going to flatline at levels of economic activity not that much higher than where we were pre-pandemic, and you said, okay, so unemployment end of 2019 is about 4%, where do you think it'll be? With zero growth 3 years down the line, I'd have sort of had a sort of 6.5% type unemployment rate, not as high as the peak after the global financial crisis, but materially above where we are today. Unemployment, until a few months ago, was still falling. We got down to a low of 3.5%, and it's just begun to start ticking up. Some of the survey data, though, and that's really what this red line is, a survey by KPMG and the Recruitment and Employment Confederation. This is just the index, just on the left-hand scale. As you can see, that has been moving down quite decisively for over a year now. That survey tends to lead the official employment statistics by almost a year, about 9 months. And that survey is telling us we've still got some more downside. And as you can see, in broad terms, it correlates, the red line in the survey correlates reasonably well with employment growth, actual employment growth, the blue line on the right-hand axis. So I'm not saying you bet the ranch on this one survey, but we have other bits of evidence that employers are telling organisations that they expect to scale back their hiring. Employment growth is going to continue deteriorating. And as you would expect, given the GDP outlook, the surprise has been that we haven't seen a bigger deterioration in employment. It's obviously a positive. The labour market is more resilient. But again, it's another reason why why don't we expect a stronger recovery this year? Because these lagging labour market indicators have still to really fully reflect the impact of slower growth and monetary policy tightening. My big sort of worry over the UK, and it's not to sort of reignite a sort of Brexit debate, but I think one of the problems that with hindsight, with the sort of Remain campaign, it may have given the impression that from day one of post-Brexit there would be economic calamity, and of course that's not the case. It's a much slower underlying adjustment. But I think where you really do see the Brexit impact is this left-hand chart, business investment. So this is expenditure by businesses. It could be anything. It could be plant and machinery, vehicles, IT equipment, buildings, and across all sections of the economy, manufacturing, construction, services, businesses. And this green line, this is, as per that earlier GDP chart, it's in level terms, in real terms. And you can see since 2016, the year of the EU referendum, the level of investment today is no higher than where it was in 2016. The dotted line, highly scientific economic projection here. This is basically just what was the previous trend over the previous decade or so? Growth of about 2% a year. Had we continued on that trajectory, now clearly there were things like the Russian invasion of Ukraine, the pandemic, that were going to affect this. But the point is, where we would have expected to be by this point, back in the middle of the last decade, the level of business investment is around 15–20% below. So in other words, there's a sense that the UK's capital stock is a bit depleted. How do economies grow? I mean, in sort of slightly abstract terms, you've got labour inputs, you've got workers, and you've got capital inputs, machinery, IT equipment, software, etc. The capital bit looks a bit light, and again, it's hard to get too optimistic about the growth outlook if we haven't had this capital investment. So I worry a little bit about this as a medium-term structural force, headwind for the UK economy. The right-hand chart is just a survey from the CBI. Member firms are asked, okay, so you're not investing, why not? What's holding back investment? The purple line you can think of, I think, as being, near-term worries over recession, the economic cycle, near-term growth, demand uncertainty. The blue line is maybe the more troubling one, low return. Why aren't we investing? Well, we don't think we can get a return. Why? I don't know, capital stock's already too low, or there are labour supply issues, or post-Brexit frictions, or whatever it is, but we can't generate enough of a return to justify the investment outlay. The red line at the bottom, financing costs, it's inched up a bit, but doesn't look particularly problematic. The yellow line, labour shortages, a sort of perennial issue. Again, something that's almost certainly been exacerbated by Brexit. And not obviously any easy fixes to those issues. The better news for the corporate sector, I'm trying my best here to give you some good news. Can only work with the material I've got, right? Left-hand chart, very quickly, the red line, corporate sector debt, corporate debt securities, corporate bonds, and bank loans. As a percentage of GDP, red line's on the right-hand scale, corporate debt is at multi-decade lows. Corporates have not piled up debt. So from a financial vulnerability perspective, I think the corporate sector looks less vulnerable than the household sector. A slightly noisy chart, apologies, on the right, but in essence, just monthly data on corporate financing, corporates have been for a couple of years pretty much been repaying debt every month. So from a financial exposure, we might go through a recession, a period of weaker growth. It's not going to be a 2008 style financial crash, at least not in the corporate sector. Corporate insolvencies are picking up. The data are quite noisy. That left-hand chart. Bear in mind, though, of course, during the pandemic, there were a lot of financial transfers, subsidized loans, a lot of debt forbearance. There's specific legislation to protect against that. So there's a bit of catch-up in some of these recent numbers from the unusually low number of insolvencies through 2020 and 2021. Our forecasts on the right, again, if you've got a flat GDP forecast, you're going to get rising insolvencies. It's a little bit elevated, but it doesn't feel like a crisis in terms of the corporate sector overall, but obviously a slightly tougher environment. Just finally on fiscal policy, the UK, you listen to a lot of the UK rhetoric, and you sometimes wonder if any of the politicians ever look at the data. You probably know the answer to that question, but a lot of the kind of day-to-day discussion is sort of couched in these terms as if we've got this slash and burn, scorched earth fiscal policy. There's no spending, no borrowing anywhere. Hang on. We're still borrowing every year, the government. Nearly 5% of GDP, over £100 billion. By the way, we're supposed to run these sort of deficits during the troughs of the cycle, not as the economy recovers, but we've got this sort of multi-year projection where deficits are essentially going to remain pretty high. That's the red diamonds, that's the overall deficit. And you can split that deficit between the blue bars, the bit that results from the economic cycle, weaker growth, results in higher spending, higher welfare payments, lower taxes, low tax receipts. And then the purple bit, this is the key point here, the purple bit's the sort of discretionary bit, the policy-driven bit. Current year, 23-24, this year, 5% of GDP deficit, more than half of that is probably the result of structural public spending and taxation policies, which, are just unaffordable, essentially. So both the current government and the Labour opposition, the right-hand chart, they both say they want public sector debt as a share of GDP coming down by the 5th year of the forecast. If you look very, very, very closely at that right-hand chart, you can just see it on the right-hand side. It just about meets the criteria for debt to be falling by year 5. What it also does, though, as you can see, we have to go up by about 5 or 6 percentage points of GDP first before it comes down by 0.2. And you might sort of wonder, what is the point of that fiscal rule? But that's the rule that both of the main parties are signed up to. I guess the point here is that when your public sector debt stock is running close to 100% of GDP, there's nothing magic about the 100% of GDP figure, but these are high levels historically of public sector debt. And if you think about it in broad terms, in order to be able to finance that, economic growth in nominal terms can't really be too far below your interest cost. Otherwise you get into this sort of death spiral. So we're getting to levels where it's going to be pretty difficult to just, splurge fiscally. Another tax cut here, more spending there. This is probably going to be a really bad election to win. Conclusions there: flatlining economy, interest rates have peaked, inflation is coming down pretty quickly, a little bit of stickiness. Wage inflation is going to be the big battleground for that, limited fiscal headroom. Very happy, by the way, if you want to distribute these slides, if anybody wants them. And we've probably got a few minutes for questions.